Now, obviously 2011 has been a difficult year for the emerging markets, and in general, in aggregate, markets have fallen so far through the end of November. The reasons for these falls, though, are not so much to do with what's going on in the emerging markets themselves, where the fundamentals and valuations look particularly attractive, as Clive will tell you about in a few minutes. It's more to do with the environment in the developed world, so the problems that we're experiencing in Europe and the US. And this really we would categorise as being three major issues. The first is a sovereign debt crisis, which sees its most obvious incarnation in the Eurozone problems that everybody knows about and which have been well publicised, but which are not going away in a hurry, it has to be said. The second issue is problems with growth in the developed world. So we see Europe potentially entering a recession as we speak here. The US growth, while a little bit better than that, is still sputtering along at a relatively unattractive level. And this obviously has an impact on investor perceptions of equity markets in general. And the third thing that seems likely to happen in the year ahead is some downward pressure on corporate profit margins. Corporate profit margins around the world have been elevated for a long period of time, and we think now that they're due for some compression. So these three developed market phenomena are weighing heavily on emerging markets, and at this stage they seem to swamp the better fundamentals that emerging markets do unquestionably offer. And that's really been behind the decline in the stock markets that we've seen so far this year. There's often been a talk about a decoupling of emerging markets from the developed world because of the fact that growth is stronger, and because of the fact that balance sheets across the piece are stronger than they are in the developed world. But the reality is that it's very difficult for these emerging markets to decouple in a stock market sense, when investors seem to take a rather simplistic view that risk should either be on or risk should be off in their portfolios. And when risk is off in portfolios, in other words, when people want to take risk off the table, emerging markets are one of the first places they look to for liquidity. And that has generally exacerbated the decline in emerging markets that we've seen during this year, where they have performed much worse than, for example, the S&P 500. Looking at some of the other issues that we have to deal with, and clearly that's the dominant feature of the current year, is the problems in the developed world weighing heavily on emerging markets. Looking more specifically at problems inside the markets themselves, inflation had been a problem during 2010 and in the beginning part of 2011, and we'd seen a tightening of monetary policy through the beginning of this year. But inflation now looks less of a problem than it was, and monetary policies typically have been easing during the course of 2011, suggesting that there is a response essentially to a slackening growth or a moderation of growth in the emerging world, and perhaps less inflationary pressure than we were looking at before. Consensus earnings also look as if they could come under a bit of downward pressure for the year ahead, and the reason for that is that obviously margins, particularly amongst export sectors, are likely to be affected by slackening demand from the developed world, and we see that leading to perhaps a slightly lower rate of earnings growth than might have been forecast 6 months ago. So that's another thing, another factor, another negative that might influence returns as we look forward. Liquidity in the stock markets, especially when we've had these global phenomena, these global sort of eddies worrying markets generally, liquidity tends to dry up when, especially amongst mid and small cap companies, when investors in general are shying away from risk. And clearly we're in an environment like that now. And it is true that underlying stock market liquidity has suffered as a result of the phenomena that we're seeing. Now that, as Clive will describe, that does actually in some cases present significant opportunity for investors, but it does also in the short term represent quite a significant risk. The global banking crisis, which obviously is most visible in Europe at the moment, can also have eddies in the emerging market world. This can be affected essentially through sort of being in a neighbouring country, and Eastern Europe is particularly vulnerable in this respect to problems in the European banking sector, even though actually the linkages may remain relatively minor. The proximity to the poor performance of the European economy is going to cause problems for Eastern Europe, and that's an area we don't emphasise particularly in the portfolio. Other things that might happen, and clearly we see to some degree, is that troubled Western banks are pulling in credit lines to subsidiaries of Western companies operating in the emerging world. So at the margin, credit might be tightening in the emerging world as a result of ripples from the global banking crisis. Something to be aware of, not at this point a major problem. And lastly, and perhaps most with the greatest degree of uncertainty, there is the possibility of a hard landing in China. We saw post-2008 a very large increase in the amount of credit supplied to the banking system, and a lot of that credit was invested in projects which were perhaps unproductive and certainly led to significant overinvestment in certain sectors, most particularly real estate. As we're now 3 years into this process, some of these bad credits are becoming more visible, and the Chinese authorities have just recently loosened policy to take effect, or to take some of the steam out of the problems which might emerge in the credit and as the credit cycle unfolds in China. So there is a risk of a hard landing. It's not, however, our central case. We expect a moderation of growth from very high levels this year into 2012. But at the end of it all, we still think growth will be on track, and certainly at a significant premium to the developed world. So those, if you like, are some of the problems that we face as we look at 2012. The most significant by far being the problems in the developed world and how they affect investors' attitudes to risk. Now, obviously, there's a positive side to talk about in the emerging markets as well, and for that, I'm going to hand over to Clive, who will talk you through some of the opportunities.
Okay, well, the flip side of falling market prices of stocks is, of course, that valuation improves. At present, we think that even allowing for the downgrade of consensus estimates, emerging markets are probably trading at something around 10 times next year earnings. This is this is not cosmically low, but it is lower than they have traded for most of the time since they've got going as a serious asset class, and up to about 90% of the time in actual fact. So we know that the valuation is attractive. The discount to the world as a whole is about 10 to 15%. It has been wider at extremes, but certainly represents decent value in that sense. And relative to the local bond markets, emerging market equities are particularly cheap. They've had bond markets generally have done relatively well since the 2008 crash in most emerging markets, and emerging market equities have not done as well. Consequently, stocks are looking cheap. So that's the good news. We're not paying up for stocks, and we anticipate in due course the valuation will probably revert to its normal range, which will give us some upside. But nothing we can anticipate that's going to happen anytime soon. Steve raised the issue of growth, and growth is something that's on all our minds because of the lack of it in the developed world. There's no doubt that the consequences of growth slowing in the developed world would be slower growth in emerging markets themselves. That said, this is growth slowing down from the sort of 6 or 7% range that we've become used to something more like 5%. In 5% growth environments, good companies with good track records can prosper, and that's what we expect to see happen. Some people say, well, you know, what if the sledging gets really hard? And the answer is that, again, unlike governments in the developed world, the governments in the emerging world have the fiscal firepower to actually stimulate domestic demand. For the most part, the budget deficits are either not large, or in fact budgets are often in surplus. The interest rates are real and can be reduced, and we've already seen evidence of this in recent months of interest rates being cut, and governments are willing to use the tools available to them to sustain demand. So we're not anticipating anything other than a relatively mild slowdown in growth. The slowdown which Steve alluded to would be much more to those outward-facing companies which are dependent upon exports in the developed world. And for those of you who know the fund, you'll be aware that our focus tends to be much more on domestically orientated companies, particularly those in the consumer sector. So there'll be some impact, but it will be mitigated compared with the average. Steve alluded to the banking crisis, which we're all too conscious of, particularly in Europe at the moment. Well, the good news in the emerging world is that banks are, for the most part, in excellent, rude health. That's not because they're necessarily any more virtuous than the bankers in the developed world, but they have had plenty of opportunity to pursue traditional banking, i.e. lending to people, not chasing returns from complicated investment products, and at the same time maintaining very strong balance sheets. The other good news of the emerging world is that unlike in the past and unlike in the present when in various places their balance sheets were leveraged, there's not much debt, particularly on corporate balance sheets. So they're not dependent on the banking system in the way that consumers and companies are in the developed world. So the banks within the emerging markets are not going to constrain growth. In fact, they may well facilitate growth. So that is excellent news. Taking the point which Steve was making about low liquidity again is creating opportunity for us. One of the elements of our trading philosophy is to get involved with stocks when they're unusually cheap, because that means that we're buying them with return being priced into them. And a lot of the time we sit there not doing a great deal because stocks aren't cheap and not a really great deal of interest to us. But just at present we're spending an awful lot of time dusting down all the research that we've done on companies which meet our fairly demanding criteria, because their prices are now coming into the range which we think are very attractive from a long-term perspective. So there may be a few additions to the portfolio for that reason. Again, on the other side, we may well take the opportunity to refocus the portfolio into areas which we have considerable confidence in the long-term prospects. So we'll be tidying up the portfolio and focusing on the traditional strengths which we think are going to represent value going forward. So it's not all bad news, and we think that in the long term, emerging markets are very well placed to deliver good returns to investors, but we may have a tough time for the few months ahead until things come a little clearer in the global investment environment.